Awesome. Well, thank you very much. First, I would like to thank Esther and the Contra Costa Bar for having me. Um, I would also like to apologize to Esther for the recent series of heart attacks. The shop family has gone through a little bit of drama that started this weekend, and so it's still ensuing, which um, I wanted to be there in person because I think a tax discussion is a lot easier in person, but it just didn't work out that way. So I want to thank you guys for being very patient with me and my current circumstances. I appreciate it. And I seriously apologize for all of the heart attacks along the way. So there we go. My name is Margaret Shop, and we are going to be talking about tax stuff. I have interlaced a little bit of like interesting IRS type facts to kind of lighten it up a little bit. As with most accountants, we would rather be having a root canal without Novocaine rather than speak in front of people. So there we go. Let's get this party started. First, I would like to say that every circumstance is different and unique. So what I may say, this trust can do this, certain circumstances may negate that. So my advice or my request and requirement is that you check with your tax practitioner. Your circumstance may not allow some things that we are listing as an option here. So your tax preparer is familiar with your situation and can guide you appropriately. So we will start with, maybe I can move the slides. There we go. Start with random IRS fact number 1. And what I wanted to show with this slide is, it baffles me, but the increase in tax revenue to the United States government is not as big as I would have thought. And it's very interesting as to where it's coming from, how it's coming from individuals, estates, and trusts, and it's not coming from business returns at all. And that trend is even though there has been a reduction in the corporate tax rate. So from a tax nerd, I just found that really interesting how it's climbed, but not quite at the rate that I would think. So when it comes to filing trust and estates returns, the first thing we like to talk through is the filing requirements. You're required to file a trust return if the gross income for the tax year is $600 or more. And it's not hard to get to $600. If a client comes in and he's got a 1099 div and it's $500, no filing is required. If it's 601, filing is required. And in most cases, that's where it's real tough for those kind of returns, because most of the time the tax prep fee generally eats up whatever income is going on. You also have a filing requirement if the beneficiary is a non-resident alien. And by that, I mean they're not a US citizen, they don't have a green card, or they don't have what's called substantial presence in the United States. And that is defined by number of days and things like that. You also have to file a return if you're holding a qualified investment in a qualified opportunity fund. If you have one of those, you know it, because there's lots of hoops that you have to do and go through in order to participate in those funds. Here's just that qualified opportunity zone. I'm hitting that hard because the people that have it really do need to file. Okay, funky random fact number 2. What I looked at here was the operating budget for the Internal Revenue Service for enforcement. Because in all of these the latest like Tax Cuts and Jobs Acts and all of the big COVID relief bills. One of the things was they were going to make up some of the lost revenue by going through enforcement. In other words, they were going to audit more and they were going to get money that way. But the operating budget for enforcement is just not there. So I'm like, well, where are you going to get the people and where are you going to get the resources in order to do all of this enforcement? Also, the operating support hasn't increased that much either. And what's happening is as staff at the IRS is quitting, they're having a harder and harder time replacing them, which means for us as practitioners, it's a harder and harder time working with the IRS, either getting information back from them or giving them information that they're missing. So some things a couple of years ago, getting a transcript from the Internal Revenue Service was super easy. It took a week, you did your 2848, you sent it in, boom, I could get transcripts electronically. Now, I send a POA in, I may not see it posted for 2 or sometimes 3 weeks. And while that's frustrating to us, it's also frustrating to the client and is probably also frustrating to you guys if you need that information. Okay, from a tax perspective, the types of trusts that we're looking at is there's two types, simple and complex. With a simple trust, all the income is required to be distributed. There is no distribution of accumulated income or corpus, no charitable contributions, and the standard deduction for a simple trust is $300. And then they make it easy. Hey, if it's not a simple trust, it's a complex trust, which is everything else. Could be where they're retaining income in the trust, could be when corpus is being distributed, capital gains, things like that is where things get a little interesting. And with a complex trust, the standard deduction is either $600 or $100. So standard deductions are not anything to write home about. This is where things get interesting, and this is what is really sometimes difficult to get a client to understand. The tax bracket for a trust is super compressed. And what I mean by that is if you look at these brackets, you get to the top tax bracket by the time you have $13,000 worth of taxable income. Well, 13.1. The domino effect from that is what we'll talk about in a couple of minutes. But suffice it to say, like an individual, sometimes you don't hit your top bracket until $300,000 or $400,000. Here, $13,000. So the intent and our strategy is always to get income out of the trust. Sometimes it doesn't matter. Sometimes it doesn't work, or sometimes there's a reason why you want the trust to pay the tax. But that's kind of our default position. Get it out of the trust so that you don't get that tax hit. There are certain things that come into play once you hit those higher tax brackets, and the Medicare surcharge is one of them. So on top of paying 37% for this, and this is just Fed, this is even talking about state yet, 37%, you get to pay another 3.8% on top of that for certain types of income. So you're at 40% right quick. And that is because you're hitting those high tax brackets really early when it comes to a trust. Another thing that happens is the capital gains rate gets high really quick as well. So normally capital gains are in 3 buckets. You've got your capital gains that are not taxed at all. And that's if your income is generally below like 70,000. Then your capital gains rate is 0. Your next bucket of capital gains rate is 15%, and that's where most people lie. And that can go up to, 300, 400,000, depending upon your filing status and things like that. Anything above that, the capital gains rate is at 20%. So if you hit that maximum tax bracket at $13,100, give or take, your capital gains are suddenly taxed at 20%. And especially if you're not getting those capital gains out of the trust, either you can't, it's written that way in the trust document, it doesn't make sense given the circumstances, whatever, capital gains are taxed at 20%, which is a 5% penalty for leaving it in the trust. So, because I haven't hit the point hard enough yet, what I wanted to display here is what your tax is given $150,000 worth of taxable income in 3 different instances, given 3 different filing statuses. So if you're an individual, your taxable income is $150,000, your federal tax is $30,000. If you're married filing joint, taxable income is $150,000, your tax is $25,000. But if you're a trust and your taxable income, the income that is staying within the trust, is $150,000, your tax is $59,000. So those compressed tax brackets really do have a big impact on the ultimate tax that is being paid. And another pain point with a trust is that these standard deductions, exemption amounts are puny. They're the 300, the 600, or the 100. But if you compare that to an individual, they get $12,000, and married filing joint, you get $24,000 worth for your standard deduction. So there again, the trusts are just getting penalized every which way if there is income that stays within that trust. This is my favorite. We call the IRS all the time. We're asking them all sorts of questions. And we joke, because sometimes it's not really a joke, is that the answer depends on who answers the phone. So here it is. In 2021, the Internal Revenue Service themselves said they answered 21.7 million phone calls. But the question of the day is, how many of those were answered correctly? Survey says they answered 94.3% correctly, which translates to 1.2 million questions were not answered correctly. It's like, oh dear. And what I thought was the most entertaining is what they said of the phone calls answered, because half the time we can't even get through. There are certain strategies, like Friday afternoon after 4, you can get through. On the day before holidays, you can sometimes get through, but most of the time, and that's still the case now, you can't even get into the queue to get through. So I like the way they chose their words carefully there. Okay, the 37,000-foot view of trust tax. Generally speaking, trust tax rules follow the rules for the individual. And there's some key exceptions. The most important concept when it comes to trust tax is to understand that the distribution is a deduction to the trust. Because what is essentially happening is the trust is taking it as a distribution, which means it's a subtraction to taxable income. Over on the beneficiary's individual income tax return, it's income there. So the IRS sort of works like that. If they have a deduction somewhere or an expense somewhere, it's probably income somewhere else. And that's how it works here. So the distribution is a deduction to the trust. It's reported on the K-1. The beneficiary reports that income on their individual income tax return. And the K-1 will list out all the different types of income, because sometimes that's important because there can be limitations, different tax rates, yada, yada. So you will see on a K-1, oh, we see that there's interest and dividends, rental income, so, section something 1250 or whatever, losses or gains and things like that. They need to be reported individually because they're reported on that beneficiary's income tax return in different places. So that's why you have to break it all out. Again, and I can't hit it hard enough, amounts retained in the trust are taxed at the trust level. And then the trust pays the tax. Sometimes that's because you want it to, sometimes you don't. And if it's distributed out, the beneficiary paid the tax in their individual income tax return. Okay. With a trust, there are, I don't know, maybe 4 or 5 different types or different ways of calculating either income or deductions. And I'll get to a spreadsheet later on so you kind of see what it looks like. This is going to sound a little weird just talking through the words. But we start with the simplest. Give us your cash. If you have a check register, people who write checks, awesome. Give us your check register and we can see the cash in and we can see the cash out. And we can kind of summarize and get our arms around income and expense. And then we take those raw numbers and we adjust it to arrive at what we call fiduciary accounting income. And the reason why we have to make adjustments there is because there are certain things that qualify under fiduciary accounting income and some things don't. So it's like that's one series of adjustments. Then you have to adjust more in order to get the trust taxable income. And that's where the tax return starts coming into play. Then there's another hoop to go through in order to calculate the distribution deduction, or DNI, distributable net income. Then when you get all of that done, you calculate the trust taxable income, you calculate the tax, and then you allocate the income to the beneficiaries. And then there's the tier 1, tier 2, which again, we'll talk about a little bit later. So we have a little spreadsheet that we put together that kind of keeps track of the ins and outs for each different type of income that we need to calculate. It's not as easy as an individual return is, where we just take all these 1099s, the interest, the dividends, all your allowable deductions, and put it in and turn the crank. With a trust, you have to take into account certain things stay in the trust, certain things are distributed out, and you have to account for that every time. We were also talking earlier, there are some components of income and expense that need to get reported separately, and they get accounted for separately. So for example, a rental, there's gross income up top here, and down at the bottom here, it might be all the deductions or the Lord, oh, my brain is going. Hold on, I'll think about it in a minute. Darn it, that's driving me crazy. My My brain just fried. Depreciation. Thank you. It's the depreciation amount. Because on the individual income tax returns, there can be limitations to the deduction if gross rental income is X, Y, and Z. So we always need to keep the little pieces and parts separate. The concept of sometimes if you take white paint and you take black paint and you mix it together, it's real hard once you've got the gray paint to separate the pieces out again. So that's why it seems redundant. Like if you look at capital gains, it's in, then it's out, then it's back in, then it's out, then it's back in. But the reason for that is so we can track all of the limitations and all of the components of those income. So the blue arrows at the bottom are the numbers that we use in the tax return. And so you can see why we have to kind of jump through all those little different hoops in order to get that calculated. Distributable net income is my favorite part. And it's a way to get income out of the trust and to the beneficiaries. It is calculated on what is called Schedule B. It's not on the first page of the tax return, but on the second page of the 1041 tax return. And DNI is calculated in two ways, because one way is never enough. And the smaller of the two deductions is the one that's taken. And we will talk about the ramifications later of that smaller of the two. But because I know this makes eyes gloss over, here is the Schedule B in the income tax return. And this is simply what it's trying to do is what I did before on my spreadsheet. I use that spreadsheet as a way to double check what is going on here, what the tax software is throwing out. I also can see all the different components and know what deduction is being allowed and what deduction is not, and what my delta is with the DNI calculated two ways. So if you see in these lines, it's making reference to a lot of previous lines, sometimes in order, sometimes not in order. But long story short, what this Schedule B is doing is it's taking the components that we input and it's calculating the distributable net income two ways. And it's giving, like on row 15, it says, enter the smaller of line 13 or 14 here. So let's start investigating a little bit more about the smaller of DNI. And why this has become more important recently. It used to not be a big deal. But with the simple trust, this actually does sometimes give you unexpected results, and clients are a little surprised. So education of the clients and as to why it's coming about is sometimes helpful. Like we referred to in the spreadsheet, it's the smaller of the actual distributions, or there's a calculated distributable net income, and it's called section 643 DNI. Let's go back and see. I'm going to really bore you guys here. There are some cases where if you get these miscellaneous expenses, in certain cases are allowed, and in certain cases they're not allowed. So they're not a deduction in the income tax return, but they are a deduction. Let me see if you guys can see this. Let me see if I can get my mouse over there. They are a deduction in this column, but not a deduction in this column. And since I need to take the smaller, this is my deduction. So what is happening is sometimes there's expenses that the trust has to pay. They don't get the deduction, and that by extension then leaves taxable income in the trust, and therefore trustee is surprised when a simple trust has to pay tax. And what it's usually the result of is financial advisor fees. But we'll talk about those a little bit more later. Okay, random IRS question number 4, because I got so muddied up in the numbers of the tax return, it's time to take a 2-second break. In what year was the IRS founded? And part 2 of that question is, what were the first income tax brackets? The IRS was founded in 1862, and it was pretty much created to pay for war expenses for the Civil War. It was supposed to be temporary. And yet here we are. The first income tax brackets were 3% on income over $800. And then in 1862, the rate on 3% on income between 600 and 1,000 and 10,000, sorry, and 5% on income over 10,000. So the concept of jiggling income tax brackets annually started early. All right. This is what we were alluding to earlier. Thanks to the Tax Cuts and Jobs Act back in 2017, it is now, I wouldn't say highly likely, that's going a little bit too far, but more often than one would guess, you do have taxable income on a simple trust. And like I alluded to before, it's investment advisor fees that are the main culprit. And the secondary culprit is expenses on the non-rental house. So they are a deduction for fiduciary accounting income, not a deduction on the tax return. And there again, you've got income left in the trust. So, and it all roots on from those, if you think about your individual income tax return, there used to be that section where you could take the 2% miscellaneous deductions. Things like your tax prep fees, your investment advisor fees, unreimbursed business expenses was another big thing that went into that category. And so people could at least somehow recoup all those miscellaneous expenses, but they're gone now for federal. They're still around for California, but they're not that big a benefit. So by reducing that 2% or eliminating that 2% miscellaneous deduction, it also had an impact on the trust returns. Okay. Another thing to talk through is Tier 1 and Tier 2 beneficiaries. Tier 1 beneficiary, mandatory distribution, and they absorb D&I first. And we'll walk through an example. I'm sure you guys can hardly wait. That will explain the impact of that. Tier 2, discretionary distribution, gets residual D&I, which can be a benefit, and gets the charitable deduction allocation. Okay, so why is this important? Why is she bringing this up? Tier 1 and Tier 2, when they get their K1, and that's the income that they're going to report on their individual income tax return, can be vastly different than what you'd think it would be. The way they look at it is If you are guaranteed the distribution, you get a higher tax burden. In other words, you get more income allocated to you, and then you are taking the higher tax burden. The tier that is the discretionary then gets the lower tax burden. So here's a simple fact pattern. Trustee is required to distribute $50,000 of income to Sam, discretionary to distribute to Barry, 80 grand of DNI. Did I do the math wrong on that? Oh, no, I didn't. And then the trust distributed 50,000 to Sam and a 40,000 to Barry. So here's the calculation, their percentage of DNI, his percentage of DNI. So if you do kind of this proportionate thing, which is logically what you would think would happen, here's what their allocation, what the income is that they have to report on their individual income tax return. But then it's like, hold on a minute, not so fast. You have what really, the way you're supposed to calculate the DNI is not on that proportionate method. You're supposed to supposed to calculate based on a tier method. Because one of the requirements is if you have a required distribution, you chomp up more of that DNI, which makes less DNI available to the tier 2. So if we look at this fact pattern, the way that the tax return is supposed to be prepared, Sam got his 50,000 DNI and he got his 50,000 distribution. Barry, he got $30,000 worth of DNI, but his total DNI was absorbed by Sam. So what you would think just allocate out DNI proportionately really doesn't work when you get to the tax return, because you do have to take into account the different tiers and who absorbs DNI first. I think that's the long and short of it. And it has a difference. You know, I'd rather pay tax on the 44,000 than the 50,000. Oh, sorry, other way around. Nope, got that wrong. Sam has to pay on the 50,000. Barry got the good deal on the 30,000 because Sam had to absorb all the DNI first to the extent of his distribution. One important thing to note is when we're talking about this tier system, it doesn't change the amount of total tax. All it changes is the amount that is being allocated to the different tiers. That's all it's doing. So total, no change, allocation does change. Okay, random fact number 5. In 1953, the IRS began teaching taxes, and they would mail tax kits to junior and senior high school principals so they could go over it with the students. I don't think, I can't imagine that working these days, but I guess you educate them early and they will pay taxes when they are adults. So there you go. Okay, another useful tool that we have is estimated taxes can be allocated to the beneficiaries. If you catch it in time, and if it's the right estimated tax. Um, it can't be a withholding tax. So, for example, let's say, I don't know, a pension went to a trust and they had amounts withheld. Those don't qualify. But if the trustee is making estimated payments in anticipation of taxable income, and then that income is distributed, and you catch all of that within 65 days after the end of the year, you can then distribute those out to the beneficiaries as well. And that's nice because then it doesn't, you don't have to file the trust return, wait for it to get processed, and then get the excess tax refunded and then distributed it out. So it kind of shortcuts the whole thing. And it is a quite handy tool. It can be used by an estate, but only in the last year. And you make the election under section 643 sub G. And yeah, like I said, within 65 days, that's key. That is what the form looks like. And then the IRS takes that information, matches it up with what's being reported on the individual income tax return. And if it all matches up, life is good. Okay, the fun part now. So as you talked about before, the communication tool between the 1041, the trust return, and the individual income tax return is a K1. And sometimes those K1s look a little wonky. It's like, what's going on? Why do these numbers not tie back to the documents I gave you? What are you doing? That sort of thing. Oh my God. Back to that spreadsheet that we looked at a whole bunch earlier, and down at the bottom, there were expenses that you allocate all to those different columns. And sometimes those expenses offset the income directly. Let me think of an example. I don't know. Let's say dividend income, and there's an expense allocation. It may allocate directly to the dividend income. The K1 will say dividend income of X, and the 1099 div will say dividend income of Y. And it's not because it's wrong, it's just because there might be instances where there are certain expenses that are allocated to income or against income, and then the K1 reports those net. So yeah, it's true. K1 does not necessarily tie back to the document, but there might be a reason for that. I alluded to earlier, the reason why we do the spreadsheet is to keep all the pieces separate. Depreciation is another thing where it's like, well, wait a minute, this isn't tying back to the tax return. You need to report depreciation separately because of certain limitations on the individual income tax return that may either allow or disallow a certain deduction based on gross rental income. And if we don't give you a K1 that has gross rental income on it, you'll never know, or the individual return will never know if they should be taking that limitation or not. Another thing to know is any capital gains flow out in the final year of that trust return. So if there are capital gains, or more importantly, the fun part is capital losses that are retained in that trust, they flow out on the final year of that trust. And they get to be a benefit to the beneficiary if they have any capital gains that they can use those capital losses for. And that's an important planning opportunity. Oftentimes, we are working with financial planners on educating them and letting them know, oh, by the way, this trust has got a boatload of tax losses. It looks like the trust is going to wind up here pretty soon. And we don't think the beneficiaries are going to benefit from that. So, are there things that can be done to take advantage of those tax losses when they're in the trust itself? So we're always trying to work with the planners in that so that we don't have all these losses accumulated, flow them out, and we know the beneficiaries are never going to be able to use those. And that's just always sad to see. Another 65-day rule, because 65 seems to be the magic number. Distributions made within 65 days of year end are treated as being made in the previous tax year. And that makes the administration, whoever your trustee is, and trying to figure out distributions and stuff like that, that makes their lives so much easier. Because oftentimes they don't have those 1099s and they don't know the exact income that they're going to have to report on that individual income tax return. And if you give them a little time after year end to get all that information together, we sometimes will drop it, like high level numbers into the trust return to kind of see what DNI and taxable income is going to look like. So we can tell them, hey, distribute this much so you can get the deduction. Otherwise, we're leaving income in the trust. We don't want to do that. I think I've beat that dead horse as much as I can. This rule only applies to complex trusts and estates, and that makes sense because simple trusts, they have to distribute everything anyway. They take the deduction, so there's not a lot of discretion with the simple trust, but there is with the complex trust. Another thing to note: distributions cannot exceed the greater of fiduciary accounting income or DNI. The deduction is the lower of those two, but the distribution can't be bigger than the greater of those two. Again, which is why that spreadsheet for us helps organize ourselves so that we know what you can and cannot do and what's applicable under each definition. The 65-day rule. Election is row 6. So you just check the box there. Boom, done. Okay. Random fact number 5. What was Harry Truman's taxable income in 1945? Okay, that's what an income tax return looked like in 1945. And if you get to the bottom of it, it really was a one-page thing. So he had taxable income of $57,000 and wound up paying $32,000 worth of tax on it. And what I kind of found interesting was Bess Truman filed her own return. So is your wife making a separate return for 1945? Yes, the name of the wife, Bess W. Truman. So there you go. I really did cram it in there. Now it's 4 pages and getting bigger. At least they're making the font bigger on the SR one, so that makes it a little easier to talk to some of our older, more experienced clients. Um, the 706, we do a lot of 706s. We do a lot of 706s for the purpose of portability. Um, you do the biggest question we get with the 706 is, when do they need to be done? It's 2 years from the date of death. There is an exception. If you're only electing portability, you can file the return 2 years, up to 2 years after the date of death. Another thing that we always get a question on the 706 is, if gross assets exceed the exemption amount, you are required to file. You may have deductions on that gross asset that gets you below the exemption amount and there's no tax due. That's fine. But if your gross estate's above, you gotta file. And yeah, when in doubt, file an extension. Extension is due 9 months after. It gives you an automatic 6 months after that. We see a lot of time with the 706, whoever the surviving spouse is at 9 months is nowhere near ready to start dealing with all of this stuff, all of these documents, all of our questions. Because 706 gets into the weeds. It gets into a lot of detail. Yeah, so as soon as we get them through the drawer, file an engagement, sign an engagement with sign an engagement letter, and the first thing we do is file the extension. We may not meet that extended deadline, but the IRS still wants the extension. I think statistical reasons, I don't know, but they want it, we give it to them. I'm not arguing with them. If they ask for it, that's what we do. One thing I wanted to mention on here is just to give some example wording that we use. One of the things we often hear as practitioners is, well, we're not done with the trust administration, so we can't get started with the 706 yet. And we don't need you guys to be done with the trust administration. There are certain places where we can just talk about gross numbers, and then that lets us kind of move forward with the 706, even though the trust administration is not finished. And here's an example of that, where we're just taking schedule totals as opposed to individual asset amounts. And that same concept applies to Q-tip property. So we don't need everything to be identified. We can still prepare the return given schedule totals, or what is allowed in the trust document. Let's see, up next is, now I'm getting into the if time allows. Sorry. So we talk about all these tax rules. We refinagle everything to kind of comply with current tax rules. And in 2025, we're all going to be super busy again because all of this changes. It's a question as to what everybody thinks the exemption amount is going to come back down to. I'd be curious to see or hear what different people have to say on that, and what different strategies are, and what people are thinking with regard to gifting before then, that sort of thing. Other things that we kind of hear coming down the pike is, and this has been talked about forever, is the elimination of the step up. And when if that finally does pass, what does that do to the planning aspect? What does it do in the drafting aspect? Um, I just would be curious to kind of hear about that. Um, it will also allow us to kind of, as in tandem, educate clients, because at least make them aware that step up mayor. I mean, they've been talking about that, eliminating the step up thing for what, 10, 15 years now at least. But who knows? So hmm, I don't know if we want to get in this sort of level. Little fee. What are you thinking? Um, thing on this screen that I really want to make people aware of is the alternate valuation. And okay, if you do not have a taxable estate, you can kind of streamline the valuation reporting. Let's just say that. Um, and assuming it's all going to the surviving spouse. We try not to use that let me rephrase that. We discourage clients from going that route. And the main reason is if those assets are sold later on down the road, it's a lot more difficult to figure out what the basis was. I mean, if it's hard enough at that point in time when you're close enough to the date of death to get values on these things, imagine what the problems are going to be 10 years down the road trying to get values on these things. And that's especially when you're looking at LLCs, partnerships, things like that. Getting records is going to be more difficult. So that's something we don't encourage. Just for that reason, what we call it downstream problems. You're gonna have a downstream problem because someday you're gonna want to sell this, and then you're never gonna know what the value of it was. And so we discourage that. I think I've got one more. This is so interesting to handle. There are elections that you can make that impacts the treatment of in-kind property when it's distributed. That's something where, just to be aware that you have options there. Talk to your tax person about the different options. Sometimes it makes sense, sometimes it doesn't. It depends on the circumstances. Another thing to know about is the Section 965, the distribution of S Corp stock. That distribution can impact the corporation because it can trigger ownership change issues. So that's another one. Before you go about and do that, either talk to the accountant, talk to the business attorney, and make sure that the S Corp status doesn't get damaged by making that distribution. And then there's certain reporting requirements that go in, but I've listed those right there. fast. I think we talked about this one already.
And Margaret, can you hear me?
Uh-huh.
Okay, I think. Go ahead.
Yeah.
No, there wouldn't be. So the way we're going to try to do this is I'm going to try to hear your question. I'm going to try to repeat it. And then Margaret's going to try to answer it. And notice the word try all the way through. So please have
Martin's got fog brain, so go for it.
Yeah. So does anyone have any questions? There we go.
Him to death.
There are no questions.
No, I actually have.
Okay, all right. She can hear you.
Okay, Margaret. And that is to does the before where does that is that that separate to does that make sense?
Margaret,
Mm-hmm.
did you hear the question or no?
Mm-mm.
Okay.
Oh, so
Here, let me,
I thought it was going to get relayed to you and then get, okay, let's go.
Okay. Can you hear me?
I can.
Okay. So my question has to do with an asset that's in the trust and it's income producing. And let's say that it's a specific gift to a beneficiary. What happens to the income that gets thrown off of that property, that asset, before the asset is distributed?
So theoretically speaking, and again, we often will go back to the trust document, but theoretically speaking, the income follows the asset. That's the general rule.
Okay, so if you had a similar situation where the asset is income producing and it's not a specific gift, but it goes to, let's say, 2 beneficiaries, then again, you said that, the income follows the asset. If it's part of, let's say the beneficiaries want to do a non-pro rata distribution, one beneficiary wants the property that produces income and the other beneficiary wants cash and securities.
Right.
How do you divide up that income? Is it divided equally between those 2 beneficiaries, or does it only go to the beneficiary that's getting the rental property?
So the first step that we do is we go to the trust document to see if there is like income goes here, assets go here, because that for us is the most helpful, right? Because then we know exactly where it's going. And then you don't put the trustee, because it's the trustee that's kind of having to do all those calculation and all that, all those allocations.
I mean, I could foresee a situation where the trust is silent because the grantor did not anticipate that one child would want the whole rental property and not anything else. So there's no discussion about where that income should go. So
Right.
In that case.
But then the question also comes up, if you've got an income producing asset and you send that to beneficiary A and beneficiary B is getting real estate or something, there's also taking into account that there's a tax burden with what A got. And there's not a tax burden with trust with what B got. So is it fair that they still get equal amounts, or how is the tax addressed? That's the question where we oftentimes get tax staying in the trust. The taxable income stays in the trust so that you don't have that disproportion. Right?
I see.
But then my question then would be, how does that, or is there a mechanism in the drafting of the trust that gives the trustee the flexibility to make an equalizing adjustment, right? You got stuck with $20,000 worth of income at 25% or whatever. So you're going to eat $5,000, whereas benefactor B got, plot of land for 50 grand and there's no tax burden. So we struggle with that because sometimes the trust is very clear and gives the trustee a little bit of wiggle room. And especially accounting for or knowing that there's going to be so many changes in tax laws, either historically or coming up. Every couple of years, there's a big change in tax laws. To draft these things to give the trustee flexibility. Oh, now they're taxing capital gains at 50%. Well, to give them a little bit room of maybe to distribute those out. Maybe that makes sense as opposed to always retaining them in the trust itself.
Okay, thank you. All right, so I have the first question, so now you have your question.
All right, we have a question. Go for it.
Would not want to distribute that either to the spendthrift trust or the special needs trust. Special needs because they never want to K1 income to retain their public benefit. As a spendthrift, you could K1 the income, but lost. Sounds like you lost the depreciation deduction. You would want to allocate those assets either as the trustee in dividing up the pile of money, or certainly not have direction from the trust forcing you to put that. I want my property to be rented out and paid for my. Does that make sense?
I have no idea. We'll check. So, all right. So
What's
the
the
question is, if you have a trust that spins off into special needs trust and some other beneficiary, is it a bad idea to have income producing property allocated?
I can't hear you that well. It's like every other word. There we go.
I'm sorry. Is that better? All right,
Yes, much. Thank you.
Okay. If you have a trust that after the person dies spins off into a special needs trust, a spendthrift trust, and beneficiaries, is it not a good idea to put income producing property into the spendthrift and special needs trust? Because you don't want a K1 where money's coming out to the special needs trust.
Right. And damage.
But spendthrift and all of that. Can you comment on that situation?
That's another case, especially with the trust, the special needs, where the trust itself is paying the tax. And then what you can do is you can work with wherever those assets are retained and who's investing them. A lot of what we see is those are invested in tax-free bonds, so that you don't get that tax hit, but you can still keep everything in the special needs trust and not damage whatever benefits they're receiving elsewhere.
Does that answer your question?
Did that make sense?
Okay. Okay, but say it again. What do you want me to ask? Okay, so he's asking if you should not allocate income producing properties to the trusts that are going to persist versus cash assets or other types of assets, in your opinion, because of the loss of the depreciation.
Oh. Yeah, I don't know what we would probably, yeah. That just so depends on what what the component of all those assets are, what the beneficiary tax rates are.
So you would
Do you?
hire a CPA and work through this issue, correct?
Well, yeah, and what are the needs? Well, I got a lot of, but I mean, it's what are the income needs of that? What is the special needs trust trying to pay for? And are you going to get enough? You know what I mean? There's so many different, yeah.
Yeah. Okay, anyone else want to attempt a question? Are we on time? I don't know. Okay, we're ending
Guys
it.
in
All
a
right.
cocktail.
Thank you so much, Margaret.
Thank you.